Thank you for tuning into this update. I'm Joshua Dobi. Appreciate so much you taking a few minutes here as we give attention to some of the happenings of the day. I was going to wait until the end of the quarter, but as the Federal Reserve made a move that was a little bit unexpected today, I thought I would jump ahead a couple of weeks and share our thoughts with you here and also do a little bit of a wrap on where we've been here during this third quarter of 2024. But first, let's go ahead and jump into what we had happen today. So as everybody who is in my end of the universe knows, the Federal Reserve was meeting yesterday and today, scheduled at their 2 o'clock meeting today, to announce what was very widely expected to be a cut in their overnight lending rate to member banks, sometimes just generally called interest rates. And they did that today. That did happen, but what happened, which was a little bit unexpected, is that instead of it being 25 basis points or 1/4 of 1% in cut, they went all the way to 50 basis points or 1/2 of 1% in terms of the cut. I'll admit, and I'll raise my hand very quickly here, I didn't think that was a very high probability. The last time that something like that happened was at the front end of the pandemic, and usually a larger than 25 basis point cut is made by the Federal Reserve when there is significant, and I would even say more severe stress in our financial and economic markets. Didn't think that was the case, speaking just for myself here, didn't think that was the case, but obviously the Federal Reserve thought that there was, or perhaps they thought that they were a little bit behind in their interest rate cutting cycle and they wanted to turbocharge it a little bit, and that's what they did here. So again, the reduction in the overnight lending rate by 50 basis points or 1/2 of 1%. Also important to note, you're going to hear if you watch any news program that focuses on the markets or you're reading any business newsletters or periodicals, probably there's going to be a lot of speculation about what the Federal Reserve is going to do at their November and December meetings. No scheduled meeting in October, but at their November and December meetings, which at this point I would anticipate there will be wide expectation in the markets that they're going to continue on a rate cutting cycle, meaning that they're going to continue to cut rates. Now, are they going to do another 50 basis point or 0.5%? Very unlikely. There would not be much historical precedent for something like that outside of some severe kind of stress in our financial and economic markets again. But I wasn't anticipating this one, so things do happen that way. So let's talk pragmatically for just a moment. What does that mean? Well, lots of things. And some things that we just plain don't know yet and really can't know for the next 3, 6, 9, or 12 months, especially depending upon how many cuts they may continue to do. But there are a couple of pragmatic things that you can keep in mind. One, because the market was largely anticipating there was going to be a 25 basis point cut and it's 50, we're probably going to see some adjustment in interest rates both on the lending side and on the savings side. It's not going to be huge. It's probably not going to change the metrics as far as the majority of folks who are making decisions about car loans, mortgages, and the like on the lending side, and also folks who are buying CDs and investing in money markets and other savings vehicles on the savings side. Probably not going to shift the masses in that regard, but there will be folks who make different decisions because of that, especially if the Federal Reserve continues to reduce rates here over the next several months, which at this point, based upon Chairman Powell's comments here earlier today, probably is going to be the case. At least that's how it looks. Now, we're not taking into account at this point any kind of geopolitical risk or other kinds of factors that we don't know today. So I'm speaking very plainly based upon data that we have at this point. But it could happen that we have some additional metrics into the system. If we get a spike up in unemployment, if inflation rebounds in any way, we may start to see the Federal Reserve cool from cutting too much as far as interest rates are concerned. But that's going to be the kind of fluid motion that we're going to see. So again, pragmatically, probably going to see some drop in rates on mortgages and on auto loans, but not much. I don't want to give the wrong impression. Largely, the market was already anticipating this rate cut, so that's really, quote, baked in to current rates, if you will. Mortgage rates, for example, on the 30-year fixed have come down pretty notably off of their high, largely anticipating that this cut was going to take place. Because it's a little bit larger than some of the market was anticipating, we may get a little bit more of an adjustment, but I wouldn't expect much. Same with auto loans, same with credit card, interest rates, and other lines of credit that are associated either loosely or closely with the overnight lending rate by the Federal Reserve. On the savings side of things, again, I expect that rates will adjust very, very modestly because we've seen over the last several weeks that the market, especially with CDs and money markets, has already been anticipating this kind of cut, so we don't anticipate a whole lot of movement here. Now, on the equity side of things, or on the stock market, we anticipate that the stock market will continue to like that. Lower cost of capital, possibility for higher margins with publicly traded companies, increased profits. That's a very overly simplistic way of looking at it, but generally speaking, that's where the market goes when we're in an interest rate cutting cycle, as it appears that we're starting here. But again, I don't want to give the wrong impression that the market's automatically going to take off, because it appears that the market largely was anticipating this, as evidenced by their movement in several equity markets after the announcement was made today. It spiked for a little bit and then came down and finished largely where it started at the beginning of today. So again, not a whole lot of movement, a lot of anticipation that this was going to take place, just a little bit of a higher movement, or a larger cut rather, by the Federal Reserve than some of the market was anticipating. So what does that mean for the balance of the year? Well, let me start first with the third quarter. As I said, I was going to talk about this in a couple weeks with you anyhow in another update, but we'll just lump it all together here. The third quarter has largely been a washing machine, as measured by our most popular indices. Some things have pulled back quite a bit, other things have maintained, and some things have eked up, but basically it has gone up and down without a whole lot of significant movement from where we ended the second quarter of this year, again, as measured by our most popular stock indexes. So what does that mean for the fourth quarter and ongoing? Well, we're going to look next, meaning we, the markets, are going to look next at, as I mentioned, is the Federal Reserve going to continue cutting rates in November and December? And if so, how much? So that the market will start to make positions and bets on what that may be. We're also, I know I don't want to get too far ahead of things, we're also going to start talking about the Christmas retail season. I know we're not even at Halloween yet, but it's going to be part of the conversation, because the Christmas retail season, as you'll remember, is very indicative of the strength of the consumer. Consumer being approximately 2/3 to 3/4 of our overall GDP, or our overall economy. Big, big deal. So the Christmas retail season is usually watched very closely. That's going to come into the conversation when thinking about how robust and how healthy we are as an economy, and I anticipate that's going to be in the mix of things. Also, in case you haven't noticed, I know you have. We're in election season, and we're going to have elections here the first week of November. There's always question, and there's always all kinds of speculation about if one person gets into the Oval Office or another person gets into the Oval Office. Friends, I need to remind you, and I know I do this every single cycle, but the president, no matter who it is, does not unilaterally affect fiscal policy. Can't do it. That's a function for Congress, and also in conjunction with other agencies, whether we're talking about Treasury or we're talking about the Federal Reserve. But the president does not have authority, whether positive or negative, in moving on fiscal and tax policy. So there's going to be a lot that's said about their particular platforms, and that's appropriate for them to say so, and the things that he or she may want to advocate, but it still has to get through Congress. So I'm watching actually the congressional races much closer, because how this Congress seats is going to be indicative of what their leanings may be for the next cycle, insofar as the next round of legislation is concerned. And then also, and you've heard me talk about this, I'm going to talk more about it in subsequent updates, there is a significant collection of tax laws which are going to sunset at the end of 2025. Not 2024, but the end of 2025. The reason why the congressional races in my world are very important is because this Congress that seats after these November elections, they're probably going to be the ones negotiating about whether some of those laws get extended, whether some of those laws are allowed to sunset, or whether there's some kind of negotiation in some kind of middle ground. So we're going to be watching those kinds of things very, very closely, especially subsequent to the election here the first week of November. So a lot going on, a lot happening. I thought it was a good idea for me to jump on a little bit earlier than anticipated to give you our thoughts about where things are. But at any time, if you'd like to chat about kinds of things that are pulsing through your television or your handheld device. And it's just a lot of noise. I know it. That's very hard to sift through and figure out the kinds of things that are meaningful, those things which are perhaps not as meaningful. I'll give you a real quick note, which you probably already know. About 90 to 95% of it is not meaningful, but it's hard to find that 5 to 10%. And I know that. So always happy to chat with you. Feel free to reach out to us, schedule a meeting time together in person, via Zoom, if that's something that works out better for you. Always happy to take a look at your particular situation in light of the things that are happening right now. Also, if you'd like to share about back to school adventures for kids and grandkids and beginning to get into the fall season, I mean, if you're a pumpkin spice latte person or not, I'm kind of indifferent to it, but I love the season anyhow as the colors begin to change and the air begins to cool. It really is a fun time of year. And also football season. Pretty awesome stuff. Although some of my most favorite teams have had a struggle coming out of the gate, but others have done pretty well. And so that's a lot of fun to watch also. But friends, always feel free to reach out. Always happy to chat with you about things that are happening in your end of the world. And until that time, I'll look forward to chatting with you soon.